All right, everybody. Welcome to the show this week. TSP Weekly Podcast. Two old guys telling you all the great things and the bad things. Sometimes it's bad things we got going on. So far, I'm still looking for this Santa Claus rally. Are we getting there? Are we going to talk about it, or are we not there yet?
We're going to talk about it. We're getting close to it. A lot of times during before the Santa Claus rally period starts, there tends to be a little bit of a lull in December. But it's hard to tell. Santa Claus rally happens about 80% of the time, and we'll get into it in the slides. But there's three big things that think stocks should be moving higher into the end of the year. 2026 is a completely different story. I think next week I'm going to put up a chart of the decennial cycle, which shows each year connected together. So the years that ending in 0, 1, 2, years that ending in 5. We were going into this year thinking there's no way you can have another 20% move in the S&P 500. But year 5 literally almost always is positive, and it's usually positive by a lot. And again, this year we got the same thing. But the year 6 is is sideways at best. And with everything
still at 26 when we get there. Let's hope for Santa Claus and visit. It's been a heck of a year for everybody. I think we need some Santa Claus.
Yeah, we do. All right, let's get into it. TSB Weekly Podcast, 14 December 2025. So we'll take a look at some of the economic highlights. We had a big Fed meeting, a lot happening at that Fed meeting, and part of it is because the Fed didn't have all the economic data that it usually has going into this meeting. But in the end, I don't think it really mattered that much. But the Fed did make some changes that are pretty important. And then we'll look at the Santa Claus rally, and then the F fund. I did /TLT and TBT. So there are a lot of people that follow the TLT, which is the 20+ year bond fund. And it's similar to the F fund, but not exactly. So we're going to take a look at that. And TBT is the opposite of TLT. So if TLT is going up, TBT is going down. So if you're looking at bonds, you can either buy the TLT when interest rates are going down, or buy the TBT when interest rates are going up. And we'll take a look at TSP fund direction. Okay, so we had several bond auctions this week. The idea is that when the government auctions off bonds, they want to pay as low an interest rate as possible to the people that are buying the bonds. And the lower the rate that we can pay, the less we are adding to the federal deficit. So the 6-month or 6-week, 3-month, and 6-month rates, which are the shorter time frame bonds, which is closer to what the Fed controls, those rates were lower. So that's a positive. We weren't paying so much as we did last week to sell those bonds. The 3-year and the 10-year were higher. So to get investors to buy long-term dated U.S. debt, we are paying a higher interest rate for that to happen. That's not a good thing. But, taking them together.
When you say that, what we're talking about is not a good thing for the U.S. economy. Not necessarily, it is a good thing for the investor. And a lot of times it's institutional investors, right? It's like right. Pensions and, these big funds are buying those higher rate, longer term bonds, which as an investor, you're happy, but that's not a good thing for the economy, right?
It's not a good thing for the government. So when I said it wasn't a good thing, it's in terms of the federal deficit.
Yeah, I'm just making that clear for folks that might slip right past it. But as an investor, you're happy, but the economy is not
a higher
happy.
Rate of return.
Yeah, and the government's going into more debt. So it just depends on how you look at it, but as to whether you like that or not. But
yeah, it absolutely does. Like if you're a bond investor, if you're a saver, basically is what they call them. If you're saving in bonds, you want to get the highest yield that you can get, right? Because every month you're getting a coupon, a check for that amount, which is great. And you're not really worried about the price because you're locking in the yield that you're going to get every month. If you're an F fund trader, right? If you're trading bonds based on the price, when yield goes up, the price of the bond goes down. So that one piece alone is kind of tricky, right? Because investors that are investing in to try to get yield want a higher yield, which means a lower price. And if you're a bond trader or you're an F fund investor, you want the price of the F fund to go up, which means interest rates have to go down. So it can be tricky to kind of get your mind around it. And then the bigger picture is that we're paying foreign investors and foreign countries that buy U.S. Treasuries. We have to pay a higher rate to them at these auctions to have them buy our bonds, which is not good. All right, then we had small business optimism rose from 98.2 to 99 in November, and that's what this kind of looked like. So this is a 3-year chart of small business optimism, and there's a lot of hand wringing. Although the S&P 500 was going up in 2023 into 2024, there's a lot of hand wringing, and finally optimism in business optimism, which is just a survey, it really started picking up in the middle of 2024, and it's been doing really good in 2025, right? So businesses are looking more. They're saying that they are more optimistic, and it's been that way for a while, and hopefully this trend continues higher, right? 'Cause that's a positive. If CEOs of small businesses are thinking things are getting better, then that's a good thing. We had the JOLTS numbers that came out. Were up in September and October. So we got September and October at the same time because the government was shut down, and those numbers were not available before the Fed meeting this week. So the JOLTS is job openings. Okay, so if there are fewer job openings, so from 23 into the middle of 24, we had fewer job openings. There weren't a lot of layoffs, right? Because the unemployment rate didn't go up, but we had fewer job openings, which is a concern for the Fed because if job openings are going down, and they were going down a lot, it basically means if layoffs begin, there's nowhere for these people to go. So the Fed's watching the JOLT number really close because it's anticipating layoffs going up. And if there's no place for people to go, then unemployment goes up in a hurry. And that's the last thing we want to see happen. So the 2 months that we did not have going into this Fed meeting were actually starting to turn positive again. So it would be really good if JOLTS started to go back up because it would be in line with the small business sentiment, right? If CEOs are thinking that the economy is getting better, their sentiment is more positive, they have more openings available, and it gives places for people to go that get unemployed in other parts of the economy. And it could keep the unemployment rate even, which would be great. Then we had the 30-year mortgage rate rose a little bit to 6.33 from 6.32 last week. This is a 5-year chart of the 30-year mortgage rate. And you can see if you were, fortunate enough back here in 2021 to lock in a 30-year mortgage, you could be 3% or less. And that's probably the lowest we're going to see mortgage rates in our lifetime. But they went up quite a bit, to a peak up here at 7 and change in late 2023. But they really haven't gotten below 6, right, since here and that first peak in 2022. And so they've oscillated between 6 and 7.5, for several years. And that's the problem in terms of affordability, because over that time, price of housing has gone up and interest rates are relatively high, and they're not coming down, even though the Fed started a rate cutting cycle back here in September 2024. So this rate cut that we just had this week was the 6th one since the Fed started cutting rates in this cycle. And it really hasn't done much. It obviously hasn't done much for the mortgage, the long-term mortgage rate. So when the Fed cuts rates, it's cutting what's called the Fed funds rate, which is the rate that banks charge each other to borrow money overnight. And the Fed expects that rate, when they change it, is going to kind of matriculate through into the longer-term bonds. But the market controls the long end of the yield curve. It's called the 10-year, 20-year, 30-year bond interest rate. The the market controls that, not the Fed. And as you can see, the Fed has lowered rates 6 times, and interest rates really, the 30-year mortgage rate hasn't moved. Okay. So Fed meeting and the reaction. So we get the Fed meeting on Wednesday. As expected, the Fed cut rates by 25 basis points or 0.25%. This was the headline from CNBC, Fed meeting recap. The Fed starts stealth easing. Powell rules out a hike, and the markets rally. So we're going to have a chart on that, but the markets rallied initially off the Fed statement. But one of the important ones, when he says it's stealth easing, so in the actual statement, in the text of the statement, it said the committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. That can't possibly mean anything to anybody unless you actually know what it means. So that's what stealth easing is. So we have been in this. The Fed has a couple of different tools to manage the market, not the stock market, but kind of keep us on a trajectory. They have 2 big tools. They can either raise and lower the Fed funds rate, or they can do what's called quantitative tightening and quantitative easing. And that's what they're talking about here when they say it's a stealth easing. So on December 1st, the Fed actually stopped quantitative tightening. So quantitative tightening is when if the Fed buys treasuries from the market, right? The Fed buys treasuries. So it's taking treasuries in and it's putting money into the market to buy those treasuries. That's quantitative easing. Quantitative tightening is when the Fed sells treasuries to the market, and the market puts money back into the Fed to take those treasuries. So it's pulling money out of the system. That's quantitative tightening. So we have been in this quantitative tightening cycle for a while. And on December 1st, the Fed stopped quantitative tightening. So the Fed has a balance sheet. It's got all these bonds on there that have different time frames on the bonds. When the times on the bonds expire, it's called rolling off the balance sheet. The bonds just go away basically because they have expired. So the Fed can take that money and buy more treasuries with it and push money into the system. That's quantitative easing. And so what they decided to do was just allow or stop allowing it to roll off the balance sheet. So the balance sheet is whatever it is. And as bonds roll off, the Fed is going to buy more to keep the balance sheet even. So it's not that it's going to go out and buy new bonds every time, which would be easing. It's going to just replace the bonds that were there to keep the balance sheet flat. So it stopped tightening. But that effect is an easing light, basically, because it's going to keep the balance sheet the same. As bonds roll off, it's going to buy more to replace them. And that buying more is putting liquidity into the system. So it's stealth easing. And the second part of the stealth easing was this, because this initiate purchases of shorter term treasuries as needed is separate, right? So this is another form of easing. They're going to buy treasuries as needed. They're going to buy treasuries as needed. It's a separate pot of money. And so that's another form of easing. So the Fed basically is telling the market in this statement that they're going to be adding liquidity into the system. So that's one big reason why we got a pop, at least initially, on the Fed meeting.
Yeah, I also heard it explained. I didn't get a chance to watch the Powell's announcement yet. But I one way I heard it explained was this is a way that they are kind of combating the tariffs issue, right? So they actually, they do the opposite things, as I understand it. I may not explain this correctly, but tariffs tend to push inflation up, and then this sort of stealth easing is sort of a sneaky way to kind of combat that. And so I do remember Powell being quoted, and I don't remember the quote, but he outright said, a lot of the issues we're having right now are because of tariffs, right? It was a
Yep.
direct kind of statement. Is that right? I know you watched it.
Yeah.
Did he come out and say something like that?
Yeah. No, tariffs from the Fed's perspective are certainly a problem. Because if he lowers rates too much, inflation comes back. A quarter point, everybody expected it. It's not a big deal. And in addition to the quarter point, you're right. He does this little sneaky workaround by doing the stealth easing. So he's getting more money into the system without really lowering interest rates and without causing inflation to go up.
Yeah, I think it's a smart move. I mean, I'm not an economist, but most of what I could gather about this whole stealth easing thing is a sort of way of flagging that you're not really going to change policy, right? They're not going into full quantitative
Right.
easing,
Right.
right? But it gives some hope to the market and to investors, and so they get back out there and
Yep.
really get, I don't know if that'll be enough to kick the market, to new all-time highs or anything, but it's supposed to give that kind of push. So
Yep.
anyway, I thought it was very interesting to see the connection between the two, because a lot of times, well, I mean, very few of us are economists, especially at this level of investing that we're all doing here in the TSP. Economics is one of those things that if you study it, you're great, you know it. But if you don't, it's really hard to wrap your head around how all these things kind of interconnect. And I thought it was very interesting that that this was like a direct response to the tariffs, and to that policy in general, whether you agree with the policy or not. Um, I just thought it was very interesting that he was able to accomplish that.
Yeah. I mean,
Or
I think he's trying to do everything he can to turn over the Fed to the next guy in May. Um, he's not going to roll over and cut rates by a full percentage point, because that's what Trump wants him to do.
right, right.
That's not what he's there for. It's not his job to do that.
Yeah, I think you're to your point. Yeah, he's doing a great job of setting this up for the next person, whoever that may be, and then it's on them, right? I mean,
Yep.
he's done everything he can to kind of keep us out of worst possible economic conditions, because we could be in a lot worse.
Oh yeah.
Um, yeah, it's a strange time. I mean, I think he
Another
also
interesting.
mentioned, and I'm looking forward to watching it, but he also mentioned, I think, just how mortgage the housing issues we're having is just, there's not one thing that's causing it. It's a lot of things causing it. And depending on where you are in the housing market, high end, middle or low end, your world is different depending on where you're at. I
Yep.
mean, just around where we're at. I mean, we're in the richest county in America, or, one of them. I don't know if it still is, but it has usually been. I mean, there's $5 million houses being built down the street from me that I'm like, who's buying these things? Right? Somebody is. I
Yep.
mean, that's crazy. But you can't. Yeah. So anyway, I don't get into the whole housing thing, but I heard he mentioned that too, and I am going to sit down and watch it this weekend. I haven't had a chance to watch his speech.
Yeah. Housing is very, very tough right now. Um, you know, when rates were really low in 2021 and price was where it was, uh, if you were paying attention, it was pretty obvious. It was only so low. I mean, the rate was like zero. I mean, the Fed had the Fed funds rate down to zero for a couple of years before that. Rates can only go up from there. And so buying a house back then was a no-brainer, regardless of what the price was, because the rate was so low, right? Now I say it's a no-brainer because what you would expect is that when rates go up, the price of houses goes down. But that's not what happened. And it's like the first time ever that that's not what happened. So as rates went up, the prices of housing also went up. And so now we are at a place where rates are relatively high, 6% on the mortgage rate, and housing prices are relatively high. So what should happen? The Fed's pushing rates down. If the bond market plays along and rates come down, housing prices should go up. But the housing market is rolling over. So we might get the same kind of cycle where rates come down and the housing prices come down, which would be great for anybody that's trying to buy a house. The other thing about rates that is really interesting, actually, is that most of the rest of the world is either keeping their rate the same or hiking. And the fact that we are in this cutting cycle has a lot of people very concerned because that's going to drive the price of the dollar down. And that we're going to, I don't know if we're going to get to that, but the dollar broke a uptrend line this week. It's going down. That's great for the I fund. It can be great. It can be good for the stock funds. It's definitely good for the I fund, and it is a tailwind for the other two.
Yeah, I'm sure you're going to talk about it. I would imagine you're going to talk about it in the newsletter this week about the dollar. I know we put out an allocation change today, and that is one of the things that drove it. And you know, I noticed that the dollar is taking a little dive. Again, it's interesting how all this stuff connects, right? You wouldn't think that necessarily is a good thing, right? And for a lot of reasons, the dollar going down is not a good thing.
Correct.
However, if you're in the TSP and you're invested in the I fund, it is a good thing. So because what you're doing is investing in the rest of the world, right? And the international fund, an I fund. So you're not investing in the U.S. as much. I mean, that's the idea behind the I fund, right? Is you know, you got those are our basic three choices, right? I mean, sometimes it seems simple, but a lot of times people don't really wrap their head around what it means, CS and I. You know, you got the S&P 500 C fund, that's the largest companies. Then you've got, you know, small, mid cap in the S fund. So some of these things are good for small businesses, right? I would fully expect that, you know, the Fed lowering the rate again is going to make businesses feel better about going out and taking loans to build stuff and to grow, right? That's the whole idea, is to kind of encourage that. Is it going to impact the larger companies? Who knows? I mean, particularly since, you know, there's only a handful of companies that are really driving the S&P, and they're not impacted that much by, I mean, they got cash upon cash upon cash.
They're not borrowing it. They're not borrowing.
Yeah, they're borrowing it different ways, right? But it's a whole different system for them. So yeah, all this stuff is interconnected. It's hard to keep track of, but it is trackable. You know, you watch shows like this and you can figure it out.
Yep.
So
the I fund is interesting too, because if the S&P is, the tech sector, I think, is like 40% of the S&P 500. It's like 5%, if that, of the I fund. And so if tech really rolls over and the dollar falls, strange as it may be, it's possible that the I fund and the C fund diverge, where the I fund goes up and the C fund goes down. Usually, over time, all three of the stock funds tend to move in the same direction. But these are not normal times. And it's absolutely possible that you could see a divergence for some amount of time where the I fund goes up and the C fund goes down. We're not seeing it yet, but it's possible. Right. So basically, the details from that Fed meeting, Paul put out no hike expected, emphasized that a rate hike isn't the primary expectation for the next move. Most people think that there's not going to be a cut in January, possibly one, maybe two cuts in 2026 is what the forecast is right now. But he pretty much took off the table that a hike is likely. Now, again, we'll see, because if the rest of the world really starts hiking rates, he's going to have a hard time keeping rates the same. And if inflation comes back, you know, there's a lot of ifs, and he's always data dependent. But this is what their forecast is. Says we're in the right place for rates, suggested the current level is close to neutral. There's a lot of conversation about that, whether or not that's actually true. And the Fed needs, of course, to assess incoming data. They focus on the data. Fed's taking a pause to carefully evaluate economic indicators before deciding a future policy. That's why everybody thinks there's going to be a pause in January. And then there were more dissenting views than there have been apparently in the last 50 years of Fed meetings. Three out of the, well, I'm not sure how many there are, three of the Fed governors dissented, and usually they're all, you know, paddling in the same direction, but they're going to start paddling in circles here in a minute, because it's getting to be kind of split. So in essence, Powell indicates Fed bias towards easing, right, or cutting, or pausing, but not hiking, at least in the near term, focusing on achieving their 2% inflation target without stalling the economy. And that's the big goal, right? How do you get inflation down? Because the only tool they really have to get inflation down is to raise interest rates. So how do you get down to 2%? without raising rates and stalling the economy. It is a tricky job he's got. And I'm actually sure he's looking forward to May when he gets to turn it over to somebody else. So this is what it looked like on the C fund on, this is a 10-minute chart. So each one of these ticks is 10 minutes of price. Here's 2 o'clock when the announcement, the statement came out. So people were reading it. And then at 2:30, that's when the Fed press conference started. So you can see that big spike up, right? The S&P was flat all morning. And then 2 o'clock, we had a big spike up because they knew that the 25 basis point cut was coming, but he also talked about that stealth easing. And once they picked up on that, the market took off. Gap down overnight. And then on Thursday, basically we had a little rally and then kind of went sideways. But pretty interesting to see kind of minute to minute what actually happens on the S&P, which is kind of the baseline. More interesting than the S&P is the commodities market. So we're talking about inflation. One of the big hedges against inflation is commodities. And so this was the price of copper on the same 10-minute scale. So copper is flat going into the Fed announcement. 2 o'clock is the announcement, and copper takes off because they're reading the stealth easing as inflationary. Okay. Same thing for silver and the same thing for gold. So commodities, gold, silver, not so much copper, but gold and silver have been obviously exploding to the upside here for a while. That's smart money that's hedging against inflation, and they still think that inflation is going to be the problem going forward. So it's definitely worth paying attention to. As much as it seems to have nothing to do with TSP, what commodities are doing now and what the bond market is doing now is really going to dictate the direction of the TSP stock funds. Okay, so this idea of a Santa Claus rally. We talk about this every year. Some of the key characteristics, right? The timing. So you get the last 5 trading days of the year, plus the first 2 trading days of the following year. So this year it's going to be December 24th through January 2nd. Historically, the S&P 500 has gained 80% of the time. So there has been a Santa Claus rally 80% of the time going back to 1950. And the average gain is about 1.3%. So we have that during that time period. So we get that to look forward to. A strong rally can be an early sign of good things to come in the new year, while a failure to appear might suggest market weakness. So the Santa Claus rally is the first of what they call the trifecta. So there's the Santa Claus rally, and then there's the first week of January. And the saying is, as goes the first week, so goes the month. So if the week of January is positive, you're looking for a positive January. If January is positive, then the rest of the year tends to be positive. So January pretty often is kind of a critical month. So we'll be talking about that as we get closer into January. So why does it happen? Some theories about it anyway. General holiday cheer and goodwill foster a positive investment mood, right? People are kind of happy around the holidays. Institutional investors are gone. They're on holidays. So it brings the volume of selling way down. And it kind of gives room for retail investors, for better or worse, to drive prices in the market. People get bonuses, right? Retail investors might invest year-end bonuses. There's tax loss harvesting, where selling losers, if you're selling, a lot of people at the end of the year will either sell winners or sell losers, but there's a lot of buying and selling going on to kind of resort yourself going into the next year. And then there's a whole lot fewer pessimists, right? Short sellers tend to be on vacation during Christmas, apparently. So that's some of the theories about why the Santa Claus rally tends to happen. So those are two big things so far, right? Going to think about positive stock prices going into the end of the year. You got the Fed cutting rates and doing stealth easing. You got an 80% probability historically of a Santa Claus rally. And then you got the F fund. So this can either be a positive or a negative. So this is the aggregate bond index. That's our F fund. The Fed had been cutting rates, since back in September of 2024. The bond market is not playing along, right? We don't. This is a pretty close in chart, so you kind of can't really see it. But the past couple of years, basically the F fund has been flat. But right now, it's putting in this head and shoulders topping pattern. So this is a left shoulder, a head, and a right shoulder. So the idea of this pattern is that this is the neckline. So what you're doing is connecting the lows, and that's your neckline. If price breaks down and starts moving lower through the neckline, the minimum downside target is the distance from the head to the neckline to the downside. So you're looking at, something like 98.80-ish as an initial downside target for the F fund if that happened. But what does that mean? If the F fund breaks that neckline and goes down, it means interest rates are going up. So if the F fund breaks down, it's doing it in the face of the Fed trying to lower rates. So it's going to be pretty interesting because the chart pattern is setting up for a breakdown. If we get support here at this trend line, I mean, it's churning right now. It hasn't broken. It's churning on that line. If we get support and rates go down, F fund goes up. That's really good for the stock funds. If the line breaks and we start coming down, it means interest rates are going up. That's not good for the C fund, but it has the least effect on the C fund because they're the big companies and they don't need to borrow money. It has the most effect on the S fund because they are the ones that need to borrow money. And if rates are going up, their optimism is going to turn over pretty quick. So again, the bond market and commodities are really important to watch. This is a TLT. There's also a TLT version in the mutual fund window, but TLT is just the 20+ year bond. So it's long bond. It's 20-year, 30-year bonds. We talked about this, I think, on the newsletter last week. There's a big gap right here. So what I was talking about last week is we could break down, fill this gap, come back up and retest the trend line, and then come down. And we didn't fill the gap this week, but we did come back up and retest that trend line and reversed. This is as of Thursday's close, reversed. And actually today, as of Friday, as we're recording this, we're down here somewhere on the TLT, and the F fund is also down. So if TLT continues down, again, it means that yield is going up, interest rates are going up, and the Fed is not going to like that. But if you're looking at this in terms of trading it, this is a great place to make a decision. If it breaks to the upside, you're good, right? If it keeps going up, your risk is very, very low. Since it came back up and retested it, if it goes down from there, if it closes below here, it's likely to keep going lower. So this is a low risk entry point. So in this particular case, it's a low risk short, meaning because it reversed at that trend line, you're expecting price to come down. And once it breaks that low, that would be a good time to sell the TLT short. And so how would you do that? You would buy the TBT, which is the opposite of the TLT. It is doing a left shoulder, head, right shoulder bottoming pattern. And so it broke through, came back, tested the trend line here, and the expectation now on this chart is that it goes up, which means interest rates are going up because the TBT goes along with rates, long-term rates. And the biggest reason why I'm pointing this out is because it's at a turning point. Both the TLT, the TBT, the F fund, all of it, once it decides which way it's going to go, it's going to have a big impact on stock funds. All right. So in general, the TSP fund direction for the week. As we're recording this, the stock funds are off. So this, it'll affect this green candle because that was as of Thursday's close, but we are still well above that 20-week moving average line. So this is the blue 20-week moving average line. Once you get above it, it's a great place to make decisions about TSP reallocation, because once you get back above it, you tend to stay there for a while. It came down here, hit it, and it was support here, right? All the way along through 2024 until we got that breakdown in March. Then we had the bottom in April. And once we got back above it, we've been back above that 20-week moving average line ever since. And then 2 weeks ago, we came down and tested it, got support there. So as long as we stay above that 20-week moving average line, we're going to get plenty of oscillation in here. But as long as we stay above that rising moving average line, price keeps going higher. Alrighty. If you guys like that kind of analysis, definitely check us out at growmytsp.com. The 2026, I mean, we'll work through it as we get there, but there's so much going on. It's gonna be a pretty fascinating year.
Yeah, now's not the time to have your head in the sand. I don't think any time is, but certainly not now. Hope everyone is having a good holiday season. Hope everything is going well in your world. If you have any questions about anything we talked about here today, please put it in the comment section wherever you find the video. We get to them eventually. We probably take a little bit to respond, and we like the questions and comments because a lot of times we're able to talk about it here on the podcast. So with that said, we will see you guys next week, and see you then.
That's it. Have a great week.